This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
U.S. diesel exports to Europe hit an all-time high in January after the continent strengthened its ban on imports of Russian-derived fuel, and as discounted Russian diesel displaced U.S. fuel in Brazil, data showed and analysts said. The developments show how Western sanctions, aimed at punishing Russia over its invasion of Ukraine, are reshaping markets, allowing U.S. producers to capture premium markets in Europe while forcing Russia to seek customers much farther from home. Notably, the EU's ban is cutting its imports from India, one of the top refiners of Russian crude.
Oil prices rose on Tuesday, nearing 7-month highs, with traders assessing risks to supply from any military escalation as another round of US-Iran nuclear talks loomed. Brent crude futures rose 48 cents, or 0.7%, to $71.97 a barrel by 0658 GMT, while US crude futures climbed 45 cents, or 0.7%, to $66.76 a barrel. Brent is trading at its highest since July 31st, while WTI is at its firmest since August 1st. At this stage, geopolitics is clearly doing most of the heavy lifting for oil prices, with the current firmness largely driven by anticipation rather than actual supply loss, said Philip Nova senior market analyst Priyanka Sakdeva.
Moving on to the top news in the energy sector.
The money Russia earned from exporting oil and gas dropped over the last 12 months, even as the country's oil exports increased in volume, according to data released on Tuesday, the 4th anniversary of Moscow's full-scale invasion of Ukraine. Russia relies heavily on energy revenues to support its war in Ukraine, a link that has led Western countries to impose increasingly strict sanctions on Russian fuel, seeking to weaken the country's military effort. An analysis published by the non-profit Center for Research on Energy and Clean Air found that Russia's revenues from oil, gas, coal and refined product exports totaled €193 billion in the 12-month period ended February 24, 2026, down by 27% from the comparable period pre-invasion.
The U.S. Supreme Court has agreed to hear a bid by ExxonMobil and Suncor Energy to scuttle a lawsuit brought by officials in Boulder, Colorado that seeks to hold the oil companies liable for helping fuel climate change in a case that could affect dozens of similar lawsuits around the country. The justices on Monday took up an appeal by the companies of a lower court's ruling that let the litigation move forward. The suit alleging state law violations by the companies seeks unspecified monetary damages for costs incurred by Boulder associated with mitigating the impact of climate change. President Donald Trump's administration backed the appeal by the oil companies. Next, we have the top news in metal market. Dalian iron ore futures drifted lower on Tuesday in reaction to the fall in Singapore iron ore prices over the Lunar New Year holidays, though recovery in production and falling shipments are expected to support prices. The most traded May iron ore contract on China's Dalian Commodity Exchange traded 1.79% lower at 740 yuan and 50 fen, $107.40, a metric ton. The benchmark March iron ore on the Singapore exchange rose 0.78% to $96.60 a ton as of 0704 GMT.
Copper pulled higher on Tuesday as Chinese traders returned to the market after holiday, while caution stemming from rising inventories and U.S. tariff uncertainties persisted. The most active copper contract on the Shanghai Futures Exchange climbed 0.75% to close daytime trading at 101,510 yuan, $14,728.88, a metric ton on the first day of the reopening of the exchange after China's 9-day Lunar New Year break. The benchmark 3-month copper on the London Metal Exchange, meanwhile, gained 1.67% to $13,084 a ton as of 0735 GMT.
We will now look at the top news in the agricultural sector.
Malaysian palm oil futures inched lower for a third consecutive session on Tuesday, weighed down by a strong ringgit and cargo surveyor data showing weak exports. The benchmark palm oil contract for May delivery on the Bursa Malaysia Derivatives Exchange declined 12 ringgit, or 0.29%, to 4,071 ringgit, $1,043.85, a metric ton by the midday break. The contract traded between 4,071 ringgit and 4,117 ringgit in the morning session. The market is looking for fresh direction, not much news to move the market, said Paramalingam Subramaniam, director at Selangor-based brokerage Pelinding Bestari, adding that the strong ringgit and weak export data pressured prices.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.